as they are on gold prices. So in the event of a slump, it's possible that they can take a nosedive too. Coming up next, Larry will tell us where he thinks stocks are heading for the rest of the year and why volatility may be here to stay. Plus, we're going to get a trader's perspective on how to play this market. That's all straight ahead on Money and Markets.
Hi there, this is Mike Larson, editor of Weiss Research's Safe Money Report. You can't just focus on stocks anymore if you want to be a successful investor, and you can't just focus on the United States either. You need to know what's going on in Asia, which Tony covers. You need to know what's going on in hard assets like oil and gold, which Sean and Larry are on top of. You need to know what's happening in currencies, the specialty of Brian Rich. You also need to keep abreast of the best ways to build wealth in an era of near 0% interest rates, and that's what my colleague Nilus Mattive covers. And of course, you need the top-down, big-picture analysis that Safe Money delivers to you each and every month. Best of all, the Weiss Elite membership gives you access to all of that and more. The Weiss Elite gives you the tools and knowledge to profit from all of these market developments. Now, I may be biased, but I think it's a no-brainer, and I'm glad you're one of the smart investors who recognizes that fact. Thanks for your time.
Welcome back. We have told you about Larry Edelson's picks for surviving and even profiting during another market downturn. He now joins us from Bangkok, Thailand, with his outlook for stocks going forward. Okay, Larry, what are you predicting over the next 6 months or so?
Jamie, as Mike was saying earlier, it's obvious from the slew of bad news that the U.S. economy stinks. Employment stinks, inventory levels are terrible, retail sales stink, consumer confidence is plunging. So I think that the rally we've seen over the past year is running out of steam, and stocks are starting to turn back down. If you look at a chart of the Dow, you'll see that stocks, they peaked all the way back in April. Sure, we've seen some big ups and downs since then, but the overall trend has been lower. Stocks, and we all have to remember, stocks lead the economy, not the other way around. So it's no surprise that the economic data coming in over the past couple of months has been negative.
Okay, Larry, so you agree with Mike that what we saw at the beginning of this month was just a bear market rally and not the start of some sustainable recovery in the market?
Absolutely, yeah. Coming out of the March 2009 lows over a year ago, we got a very powerful rally, Jamie, and it was helped along largely by government stimulus and loose monetary policy. And the Federal Reserve is still trying its best to prop up the market. So the bulls are not about to give up that easily. We've seen wild swings in the market over the past couple of months, and investors should expect those swings to continue. Another reason for the volatility is also it's summertime. Trading volume is always lighter during the summer when many traders go on vacation, and investors also. So that translates into very big swings in the market. But, I have to tell you, in my experience, it's been particularly true this year.
And why is that, Larry?
Well, quite simply, investors don't really know which way to turn this year. They're certainly not seeing a turnaround in the economy, so they're reluctant to buy. But at the same time, the market hasn't yet completely collapsed. So you have a lot of investors with a lot of cash just sitting on the sidelines and probing the market, but not making big bets either way. That's contributing to even lighter volume than usual and bigger swings.
Okay, Larry, so as we head into August and the fall, which direction do you see the stock market going here?
Well, as I said, the overall bias, the overall trend for the next 6 months or so is definitely broadly lower. But within those 6 months, we're going to continue to see some pretty wild ups and downs. In my work with Richard Mogi at the Foundation for the Study of Cycles, we've determined that there may even be another short-term rally. But stocks are likely to move lower over the next month, and especially so into September and October. Again, we might get another bounce towards the end of the year after that, but then in early 2011, we'll probably start sliding again.
Larry, are you advising investors to start betting to the downside or to continue to stay on the sidelines given the likelihood of this continued volatility?
Well, again, the bias is to the downside, but the market is still pretty much right in the middle of the recent trading range. So I would tell investors, not to be aggressively short or aggressively long here until we get confirmation of the downside.
Okay, Larry Edelson out of Bangkok. Thank you, Larry.
No problem. Thank you, Jamie.
Okay, we have heard now about the relationship between the stock market and the economy and how to invest if you're trying to protect your money. But how are traders playing the market? Well, joining us with his perspective is Tom Essay. Tom's the Vice President of Research for Weiss Research and a former trader on the New York Stock Exchange. Okay, Tom, what are you seeing in the recent market moves?
Well, in a nutshell, Jamie, the market is compressing. The stocks have been swinging back and forth for the last month or so, but the range that they're trading in is becoming more narrow. If you look at the S&P 500, for example, it's been trading between about 1,100 on the top and about 1,050 on the bottom. So when traders see that, it tells them not to bet too heavily in either direction.
Okay, Tom, so you agree with Larry then that investors should be what, somewhat risk averse right now?
Well, yes. Look, when you're trading on the floor and trading real money, big opinions either way can cost you a lot of money when you're wrong. So in this type of market, you really want to wait until we break out of that trading band. Whether we break out to the upside or the downside, stocks are going to move very hard and very fast once it happens. Then you'll have plenty of time to get on board and take advantage because the move will likely be a long one. But while we are still in that trading band, you have to be very careful.
Okay, Tom, if you were back on the floor right now trying to trade this market, what would you be doing? Just sitting on the sidelines?
No, not necessarily. You want to be watching the market closely so that when it does break either way, you're ready to pounce. But until then, you want to be making trades that don't commit you too heavily either way. For example, I might buy when the market gets to the bottom of its trading range or sell when it gets to the top. But I would put tight stops at either end of that trading band that would allow me to make bets one way or the other, but not get killed if the market breaks out in the opposite direction. And it's doubly important to hedge your risk now, because not only have we been trading in this narrow range, but the moves have been so volatile within the trading band.
Larry suggested that the recent volatility has a lot to do with light volume. Do you agree?
That's definitely part of it, but it's also because there's so much event risk. Every day there's something happening, a new headline, a new earnings report, a new economic report. Sometimes investors react positively and sometimes they react negatively. But none of it is enough to resolve the overall economic and policy-related uncertainty that's keeping the market banded. That's because none of these individual pieces of news is answering the overarching question, which is, are we going into a double-dip recession? And until we get a definitive answer to that question, the market is going to stay like this.
Okay, Tom, that is the biggest question. When can we expect an answer?
Well, the market will resolve the question long before the economic data does and shows us. But just as you saw the market begin to decline in April before the economic numbers confirmed this recent slowdown in growth. But I think we may have to wait until November before we get an answer in the form of a dramatic move in the stock market. The reason I say November is because a large part of this equation is what the government is doing. Regardless of your political views, the market does not like financial regulatory reform, and it doesn't like the health care bill. And that's not because of policies, but because of the lack of specificity. There are thousands of rules that are yet to be written, and we don't know how those rules will be enforced. So that's causing a lot of uncertainty, and markets don't like uncertainty.
All right, Tom, is the solution here for traders just to ratchet down their risk in order to minimize all this uncertainty?
Well, yes, and when you ratchet down your risk, you of course also have to ratchet down your profit expectations. The whole point of trading through this type of market is to make sure you're still afloat for when it breaks, because that's when you'll be able to make a lot of money.
All right, Tom, thanks so much for joining us.
Thank you.
Well, uncertainty. It's impossible to know for sure which way this market's going to go when it finally breaks out of its trading range. Now, there's strong evidence to support the view that it will head lower, and we've given you ways to profit if that happens. But we've also shown you how to take a more conservative approach if protecting your money is your main concern. Coming up next week, we'll revisit this topic of the flagging economy. How is the Federal Reserve attacking the problem? And what do Ben Bernanke's recent comments indicate about our prospects for turning things around? Martin Weiss will be back for that conversation. But in the meantime, we want to hear from you. If you have questions about any of this week's topics or suggestions for things that you'd like us to cover, just let us know at Weiss Money Network at weissinc.com. I'm Jamie Holmes, and now, Mike Larson.
Thanks, Jamie. We've talked a lot this week about trading bands, market trends, and stocks' relationship to the economy. But what it all boils down to is this: how does the stock market affect you? Now, if you own stocks, whether as a trader or an income investor, the answer is fairly obvious. But even if you're not invested in the stock market, what happens on Wall Street can change your life, for the good or for the bad. I want to make sure you know about the ways in which that can happen. For instance, a dip in the stock market can make it more difficult for companies to raise money. That can make it harder to get loans, which then means a drop in consumer spending. It also means you'll have to work longer hours and have to save more to make up for losses that you've had in your retirement plan. But if the market falls and the economy follows suit, it's not necessarily bad for you. Heck, it may be an opportunity to lock in dividend yields of 8% or 9% on some of the best blue chip companies out there. Or you can scoop up a house for pennies on the dollar and turn around and sell it or rent it out for a huge windfall. Bottom line, a lot of experts want you to cower in fear. But if you listen to our warnings and advice, you can turn the tables on them. We warned about the internet bubble in the late 1990s. We warned about the housing bubble in the middle of the last decade. You may not have listened then, but if you listen now, you could find yourself in a position to take advantage of the opportunity of a lifetime. Don't fear the bear market. Grab it and hold on tight. I'm Mike Larson. Martin Weiss will be back next week on Money and Markets. Thanks for watching.